There is a moment every month that most retirees just let pass by. Your Social Security payment lands in your bank account, and within a few days, it quietly disappears into bills, groceries, and expenses. With no real plan, no structure, and no strategy behind it. The money came in, and the money went out, and you are left hoping it stretched far enough until next month. If that sounds familiar, you are not alone. According to the Social Security Administration, the average retired worker in America is receiving around $2,080 per month as of 2026. That is just under $25,000 a year. For millions of retirees, that check is not a supplement to a bigger income. It is the income. And yet almost nobody has been taught what to actually do in the hours and days right after that payment arrives. That is exactly what this video is about. My name is Julian Voss, and this is Julian Voss Retirement. Today, I am going to walk you through 5 specific things you should do the day your Social Security hits, in order, step by step, so that every dollar you receive works harder, lasts longer, and costs you less in taxes. This is the routine that most financial advisors never teach their clients, because frankly, most advisors are focused on people who are still accumulating wealth. You are in a different phase now. You are distributing. You are living on what you built, and that requires a completely different playbook. Let's start with step 1. Step 1 is to check your net deposit before you touch a single dollar. This sounds almost too simple to be worth mentioning, but here is why it matters. Your Social Security benefit is not always deposited in the full amount you expect. There are deductions that come off the top before that money ever reaches your bank account. And if you are not reviewing them every month, you could be paying for things you no longer qualify for, or missing an error that has been quietly reducing your check for months. The 2 biggest deductions that come off Social Security before you see it are Medicare Part B premiums and, if applicable, federal income tax withholding. Medicare Part B in 2026 has a standard premium of $185 per month. But here is something a lot of people do not realize. Not everyone pays the standard amount. If your income from 2 years ago exceeded certain thresholds, you may be subject to what is called IRMAA, the Income-Related Monthly Adjustment Amount. IRMAA surcharges in 2026 can add anywhere from $74 to $419 on top of your standard Part B premium, depending on your income bracket. That is a significant extra hit every single month, and many retirees are paying IRMAA because of a one-time income event that happened 2 years ago. A home sale, a Roth conversion, a large distribution, an event that does not reflect their current financial situation at all. The IRS and the SSA look back 2 years. If your income spiked in 2024 for any reason and you are now subject to IRMAA in 2026, you have the right to appeal it using a form called SSA 44, but you have to know you are being charged it first. That is why the very first thing you do when your Social Security lands is open your bank account or your My Social Security portal and look at the exact deposit amount. Compare it to what you expected. If it is lower than it should be, find out why before you do anything else with that money. The second deduction to check for is voluntary federal tax withholding. Some retirees elect to have federal taxes withheld directly from their Social Security, which can be smart, but only if you set it up correctly. You can choose to have 7%, 10%, 12%, or 22% withheld. If you are withholding more than you actually owe based on your real income situation, you are giving the government an interest-free loan every month. Conversely, if you thought you set up withholding and it is not happening, you may be building a large tax bill that will surprise you in April. Check the deposit. Know the number. That is step 1. Step 2 is to fund your bills account first, not your spending account. Here is a mistake that most retirees make without realizing it. They receive their Social Security into a single checking account and then spend from that same account throughout the month. What ends up happening is that by the time the next payment cycle comes around, the money is gone and there is nothing left as a buffer. The solution is a 2-account system, and you can set this up at any bank or credit union for free. The idea is straightforward. You maintain a dedicated bills account, sometimes called a fixed expenses account, and a separate everyday spending account. The moment your Social Security deposits, you transfer the exact amount needed to cover your fixed monthly obligations into the bills account. We are talking about rent or mortgage, utilities, insurance premiums, phone, prescription subscriptions, any recurring charge that happens on a predictable date. You calculate the total of all those fixed expenses, and that amount goes directly into the bills account the day your check arrives. Then you do not touch that account for anything else. It is not your spending money, it is your obligations account. Everything left over after that transfer is what you have available for groceries, gas, personal spending, and discretionary expenses. This system does one important thing that most people underestimate. It eliminates the anxiety of watching your balance drop throughout the month and wondering whether you will make it to the next payment. When you know your bills are covered from day one, the remaining balance in your spending account becomes a clear and honest picture of what you actually have available. No guessing, no mental math, no surprises when a bill hits and your balance is lower than you thought. If you are on a fixed Social Security income and the numbers are tight, this two-account structure can also reveal very quickly where adjustments need to be made. It makes invisible problems visible, and that is always better than discovering them on the day a payment bounces. Step 3 is to move your buffer to a high-yield savings account, not a regular savings account. After you have funded your bills account, if you have any portion of your Social Security payment that is excess, money beyond your fixed and variable monthly expenses, that money needs to be in a place that is actually earning something while it sits. Most people keep their reserve funds in a traditional savings account at a big-name bank. Right now in 2026, the average traditional savings account at a major bank is paying somewhere around 0.3 to 0.5% APY. The best high-yield savings accounts, by contrast, are paying up to 4.5 to 5% APY at online banks like Marcus, Ally, SoFi, and others. The difference is not trivial. If you have $10,000 sitting in a traditional savings account earning 0.4%, you earn $40 in a year. If that same $10,000 is in a high-yield account earning 4.5%, you earn $450. That is $410 extra dollars you are leaving on the table by not moving your money. High-yield savings accounts are FDIC insured up to $250,000 per institution, just like regular savings accounts. The money is just as safe. There is no catch. The only difference is that online banks have lower overhead than brick-and-mortar branches, so they pass the higher interest rates along to depositors. If you have not already moved your reserve funds to a high-yield account, the day your Social Security arrives is the best reminder to finally do it. Make the transfer. Your money should be working while it waits. Now here is something important about this step that ties directly to step 4. The interest you earn in a high-yield savings account is taxable income. And for retirees on Social Security, that extra income is not neutral. It can actually trigger a much larger tax bill than you expect because of the way Social Security is taxed at the federal level, which brings us to the most overlooked step in this entire routine. Step 4 is to do a monthly provisional income check. This is the step that almost nobody does, and it is the one that could save you the most money. Here is how Social Security taxation works, and I need you to pay close attention because this surprises even people who have been retired for years. Social Security benefits are not automatically tax-free. Whether your benefits get taxed, and how much, depends entirely on a number called your provisional income, which the IRS also calls combined income. Provisional income is calculated like this. Take your adjusted gross income, not counting Social Security. Add any tax-exempt interest you received. Yes, even tax-exempt income from municipal bonds gets added back in for this calculation, which shocks a lot of people. Then add 50% of your annual Social Security benefit. That total is your provisional income. Now here is where it gets serious. If you are a single filer and your provisional income is below $25,000, none of your Social Security is federally taxed. Between $25,000 and $34,000, up to 50% of your benefits can be taxed. Above $34,000, up to 85% of your Social Security benefit becomes taxable income. For married couples filing jointly, those thresholds are $32,000 for the lower limit and $44,000 for the upper. Above $44,000, up to 85% of your benefits are taxable. Now here is the part that makes a lot of retirees genuinely angry when they first learn about it. Those thresholds, $25,000, $34,000 for single filers, $32,000 and $44,000 for married, those numbers have not changed since 1983. Congress set them in 1983 and never indexed them for inflation. In 1983, only about 10% of Social Security recipients paid federal tax on their benefits. Today, because of 4 decades of inflation, nearly 50% of all Social Security recipients pay tax on their benefits, not because they are wealthy, but because inflation pushed their income above thresholds that were designed 40 years ago and never updated. The average Social Security benefit in 2026 is around $2,500 a month for some recipients. If you receive that amount and you also have any other income, a small pension, interest from savings, IRA withdrawals, you may already be above the threshold without realizing it. Every dollar of extra income you earn does not just cost you that dollar in taxes. Because of how provisional income works, each extra dollar of income can trigger taxation of your Social Security too. Tax professionals call this the tax torpedo. In certain income ranges, your effective marginal tax rate can jump to 30 or even 40% because each new dollar of income pulls more of your Social Security into taxable territory. The monthly provisional income check is how you stay aware of where you stand before it becomes a problem at tax time. Here is what you do. Once a month, when your Social Security deposits, take 5 minutes and add up all the income you received that month from every source. Pension payments, IRA withdrawals, interest earned on savings, any consulting or part-time work income, capital gain distributions from mutual funds. Divide your annual Social Security benefit by 2 and add that to your estimated annualized income. That gives you a rough provisional income number. Compare it to your threshold. If you are approaching or crossing the threshold, you have time to make adjustments. You might reduce an IRA withdrawal that month. You might shift some spending to a Roth account, since Roth withdrawals do not count toward provisional income. You might make a qualified charitable distribution from your IRA instead of taking a regular distribution, which removes that money from your taxable income entirely. The point is not that you need to become a tax expert. The point is that you need to be aware of your number because nobody else is monitoring it for you. Your bank does not alert you when you are approaching the threshold. The SSA does not warn you. The IRS certainly does not warn you. This monthly check is your early warning system, and it costs you nothing but 5 minutes of attention. Step 5 is to make at least one intentional financial decision that day. This is the step that separates people who build stability in retirement from those who simply survive it. What I mean by an intentional financial decision is not complicated. It does not mean you need to call a broker or rebalance a portfolio. It means that on the day your income arrives, you make at least one deliberate, forward-looking choice with your money, rather than letting the month happen to you passively. That intentional decision could look different for everyone. For some people, it means setting aside a specific dollar amount into a named savings goal, whether that is a home repair fund, a travel fund, or a medical expense cushion. Having a named account or envelope for a specific purpose makes you significantly more likely to actually protect that money versus spending it on something else during the month. For others, the intentional decision might be reviewing their Medicare coverage. Open enrollment for Medicare Advantage and Part D plans happens every year from October 15th through December 7th, but the day your Social Security arrives is a good monthly prompt to ask yourself one simple question: is the coverage I have still the best available option for my situation? Drug formularies change, premiums change, and the plan that was cheapest when you enrolled may no longer be the most cost-effective. Reviewing this takes 10 minutes, and if you find a better plan, the switch happens automatically on January 1st. For others still, the intentional decision might be something as simple as logging into your My Social Security account online and checking your earnings record. Mistakes in earnings records happen more often than people realize, and errors in your record directly affect your benefit calculation. If you spot an error, a year of work that is missing, income that was not recorded, you can file a correction, but you have to actually look first. Whatever the intentional decision is for you personally, the habit of making one each month on payment day builds something that no single financial move can build on its own: financial awareness. Awareness is what prevents the kind of slow financial erosion that most retirees never see coming until it has already done significant damage. You do not have to have a perfect plan, you just have to be paying attention. So let's put the 5 steps together as a complete routine. When your Social Security deposits, the first thing you do is verify the exact amount and confirm there are no errors or unexpected deductions, especially IRMAA surcharges you may be eligible to appeal. Second, you immediately transfer your fixed monthly obligation amount into your dedicated bills account so that money is protected before the month begins. Third, any buffer or reserve funds go into a high-yield savings account earning up to 4 or 5%, not sitting idle in a traditional account earning almost nothing. Fourth, you run a quick 5-minute provisional income check to see where you stand relative to the Social Security taxation thresholds, so you can make adjustments before they become a tax bill in April. And fifth, you make one intentional forward-looking financial decision. Review a benefit, fund a goal, check a record, optimize a plan. The whole routine takes less than 30 minutes once you have done it a few times. But the impact of doing it consistently, every single month, every time that payment arrives, compounds in ways that are genuinely hard to overstate. It is not dramatic, it is not exciting, but over a year, over 5 years, over the rest of your retirement, the retiree who follows a deliberate routine with their fixed income ends up in a dramatically different financial position than the one who does not. If you found this video useful, I want to ask you to do one thing. Share it with one person you know who is on Social Security or approaching retirement. Not because it will help the channel, but because most of the people who need this information have never seen it presented this clearly in one place. And the difference between knowing this and not knowing it is real money. This is Julian Voss Retirement. Subscribe if you want to see more content built around the retirement decisions that actually matter. I will see you in the next video.